So how we integrate everything in MoneyWise Smart. So I'll just explain how we do things in MoneyWise Smart and how we think about this. We have this offering called the research series. Right now, we just have the free version, and very soon we are going to launch the premium version. Right now, Fan Liang and I, we are working on some very interesting businesses in the payments industry. These are very high growth businesses, generate excellent return on capital. So typically in our research series, we spend a lot of time researching our businesses, and we look for businesses which are very high quality. What's the definition of high quality? Run by excellent quality management. They have been profitable, generating high return on capital, have very strong moat, that is competitive advantage. We would prefer businesses which are able to grow their gross margin, which operate in massive, the total addressable market should be very high. Their growth rate should be very high. And last but not the least, we prefer businesses which are exponential in nature. The SaaS businesses qualify, some of those well-run SaaS businesses which are profitable, businesses which enjoy network effect. So in our research series, we cover a lot of those businesses. And, the premium version is going to come with 3 such new businesses. So that is the research part. Most of our time goes there. After that, we, have our analysis framework, which we teach in our investing fundamentals program. So there we have an extensive framework where we first start with, the risk evaluation. Then we look at the business. Do we understand the business? Does this business take all these qualitative factors that I just discussed? Does it take all the quantitative factors? We spend extensive, this framework, looks into the financial statements in a lot of depth and sees if it ticks all the boxes. And then we arrive at a rough valuation of the business. Now, once we arrive at the rough valuation at the business, unfortunately, these days, as you all know, what's happening is that we see that the market price is way above what our range of valuation is. And I just explained to you why, just sitting on cash, generating 0% return is not my preferred objective, because I have no idea, say a company XYZ, which I have spent so much time researching. I really like it. I understand the value of this company. There might be companies which I may not be able to buy in the next 5 years, but, we think long term. We will still keep tracking these businesses under our research series. But in these 5 years, instead of sitting and twiddling my thumbs, that's where our option series strategies come in. So we use different types of strategies to take advantage of such situations where the market value is, where the market price is way above the intrinsic value of the share price. And sometimes if we see, the market price is shooting up, there are other types of strategies that we do, which we cover in the option series. In fact, we have lots of case studies there, which, people who are our subscribers, they have also gone through many of these case studies. So in MoneyWise Smart, we don't think of options as a short-term trading tools. I mean, very, very rarely we do some speculative positions. Like this year, I have done a couple of them, but, again, because of fundamental reasons, because of things which I understand about those businesses. So our options, the offering is unique in that sense. Frankly, I haven't come across any other provider anywhere in the world where the options strategies are completely integrated with their long-term investing. You keep hearing people who say that, oh, this is my investing portfolio and this is my trading portfolio. We don't separate like this. For us, it's just one portfolio. Fanliang and I, we consider ourselves as business owners. We like a few businesses, and we will probably track them, till we find something much better or till there's something fundamentally wrong in these businesses. And everything else revolve around that. So in option series, we cover strategies that we use to build our portfolio and enhance our returns on high quality businesses that we cover in research series using the framework which we teach in the investing fundamentals program. So everything is well integrated for us. So these are like, the three pieces of the jigsaw puzzle. That's how we look at the whole thing. Now, for those who are not our subscribers and those who are interested in knowing more about the option series, Fanliang, if you can please, share we have a brochure. So you can, take your time, you can go through the brochures. We have provided all the details, and we also have 3 different levels of subscription. So we have explained what those levels contain. So just take a look. Now, coming back, we will look at a case study of a company called Expiry. Now here I will, this is the company which Fanliang had some time back, I think last year, he identified, and this ticked all the boxes which we look for. So we found it very interesting. We spent a lot of time researching the business. For those of you who are on research series, you would have seen, or on our YouTube channel, we published some of the videos. We published an overview video. We did detailed, very in-depth research on the moats, the competitive advantages. We looked at all their competitors, looked at their strengths, their weaknesses. We looked at the industry in detail. We looked at the risk. We spent a lot of time studying the management. And you know what? During March, when the sky was falling and Expiry also got hit like other companies, we actually did a stress test, and and the premise was very simple. What if, the company loses 70% of its revenues, or some absolute crazy number? Will the company survive? And that kind of stress test we did. So it kind of ticked all the boxes. And, we felt good. And subsequently, we have been also tracking all the earnings, all the announcements. So whenever there's an announcement, we cover that and we update that, to our subscribers. And we even did a detailed valuation. So Fanliang spent a lot of time doing this, and, don't get confused by all this. This is just a screenshot. So we arrived at an approximate range of valuation of between $60 to $80. That was the approximate range of valuation. And look what has happened to the share price over the last, 1 year. It has been an absolute roller coaster ride. Now, here, let me ask you a question now. Let's say, the share price is somewhere here, $90 or maybe $100, whatever. Now, it's very easy to come up with a valuation at this point of time and say that, when the share price falls to the range of our intrinsic value, we will buy them. But I'm sure all of you know, I don't have to remind you that when you see the stock price, literally going to a free fall like this, it's very difficult to pull the trigger, because, there are these trading terminologies like a falling knife and all that stuff. I mean, not that I pay too much attention to those, but because of our framework, our framework, the way we research companies, the way we analyze companies using the framework in investing fundamentals and our option strategies, it allows us to remain unemotional. So yes, that's exactly what we did when the share price kept dropping. This is the zone where, I actually purchased, that's the difference between Fanliang and I. I think I'm a bit more aggressive. So the moment I see the share price comes within a range of intrinsic value, I just pull the first trigger, and my purchase happens over the years. So I kept on purchasing. I think Fanliang is much more conservative. He's probably smarter than I am. So he was waiting he probably got a much better price. So So I kept buying all the way because this is in my zone of intrinsic value. And after that, just imagine my lowest point purchase happened at around 30, and and thanks to dollar cost averaging, the number of shares I bought at this point is much higher. And subsequently, the share price, ran up. So now I haven't filled up my quota of purchase. The share price is, even though it's within our range of our intrinsic value, but you know what? When we did the initial analysis, we did not think of COVID. But right now, because COVID has hit, I want some additional margin of safety. So I have drawn this green line on the sand. So I'm telling myself that even though earlier I purchased at $65, $70, now I will only purchase if the share price comes down to $50, right? Now, it might so happen that it will never come down to $50. Fair enough, I will sell put options. And that is exactly what I have done. So I have looked at the $50 strike put of NSP expiring in 205 days. And I want to invest, you remember the model portfolio of $100,000. So I want to invest 5% of that, which is $5,000 of my model portfolio in Expiry unemotionally. That is the important thing, so that, it's part of my system. So what I do is I position myself to purchase 100 shares at $50. How do I do that? By selling one put option contract of 50 strike. So you see this put option contract of 50 strike, I sell and I bring in $4.40. And I want to be assigned. So I keep aside the $5,000. And by the way, I don't, pay any attention to brokerage margin and all, because the brokerage company will probably just need me to put up, $1,000 or $2,000, but it doesn't matter. In my mind, I don't care for leverage at all. My, our investment strategy itself, I think, over a period of time will generate healthy returns. So we don't want to take unnecessary risk with leverage. So I will keep the entire $5,000 aside, maybe parked in treasury securities, which will generate a little bit. That's of course outside this particular session, outside the scope. So I'll keep this $5,000 aside. And on that $5,000, so I treat this as if I have already invested this $5,000, though I will only need it if the share price comes down to 50 and if the holder of this particular option exercises the option. So I have to fulfill my obligation of buying it. And by doing that, I get a premium of $4.40 multiplied by 100. The multiplier is $440. So even if I don't get assigned, this is a very healthy return on the funds which I have allocated for the possible assignment, which is these $5,000. So if you look at it, a return of $440, and don't forget, I'm receiving this upfront. When you invest somewhere, and let's say you receive your return after a year, let's say if I keep my money in a deposit which pays me 4% return, I will only receive that interest after a year. But the beauty about selling a put option is, or selling an option is, I receive this return upfront, this cash flow. So for a 205-day period, this is equivalent to an annualized return of 16.2%. However, this 16.2% is the return if I receive this $440 at the end of the 205-day period, that is on expiry. But I'm receiving this upfront. So that gives me an opportunity to invest this $440 upfront and generate some additional return. So that annualized return would be even higher. It's around 18%. And in option series, we have, multiple modules where we have explained the calculation of how to look for the return, how to calculate the return and all these things. So see, just by sitting on the cash, I would have got zero, but by positioning myself to purchase the stock at $50, I'm bringing in a return of 18%. And if I'm able to generate, 18 is higher than 15. I mean, above $15 return even on the cash. Won't that be pretty cool? That means on my entire portfolio, I'm generating a 15% return instead of the earlier 10%. And this difference of 5% over years, it's huge. It over a 20-year period, 30-year period, over a lifetime, this will amount to like many, many millions of dollars. You can just do the compounding calculation, just $100,000 compounded at the rate of 15%. I'm sure you can do it. So that is the benefit of this integrated strategy which we use. You can use it on any stock that you analyze and that you want. So now I'm going to actually go to our interactive brokers platform, and let's take this particular case study to its logical conclusion. So what I'm going to do is I'm going to share my interactive brokers screen. If someone can please let me know if you can see my interactive brokers screen. Can someone type a yes? Okay, thanks, Vaibhav. All right, thanks, Ruth. Okay, so here is the NSP option chain. This is how the interactive brokerage platform looks like. And by the way, guys, whether you use interactive brokers or not, interactive brokers provides this simulated trading account. This is a paper trading account. It is free of cost, and you get to enjoy and familiarize yourself with the platform using this without taking any risk. So I would encourage all of you to open a paper trading account on interactive brokers. For a lot of newbies, you find the platform, a bit complex. Just spend some time watching their videos. They have walkthrough videos. I know Vaibhav, a friend here, he has been using interactive brokers for many years, over a decade. I have been using it, and we absolutely love this platform. So this is the option chain of NSP. So let's go and do the trade. So we decided to, just one second, we decided to do the 16th April option. So what we will do is, you see, these are the various expiries written here. So I go to more and I select the farthest expiry, that is 16th April. I probably would have selected a expiry if anything, even later dated was available, but now that only this is available, I take this. And surprisingly, just think of the coincidence, guys. In the part 1, exactly at 9:28, I went to interactive brokers and I said that, oh my God, the market is still not open. It was 2 minutes away, and today it's exactly at 9:28. We have to wait for the market to open. So while we wait for the market to open, and I will actually do the trade and I'll show you. Let's go back to our presentation and let me complete that part. We are almost there. And then once the markets open, I'll come back to this. Okay, so you can see my screen, right?
Yep.
Okay, great. All right, so yep, so we've seen this return, we see how this benefits us. So this is just to summarize what we learned today. We looked at the structure of a put option. We looked at the benefits of buying a put option, the disadvantages of buying a put option when we end up paying too much for the extrinsic value. What does selling a put option mean and how we can benefit from it? Traders look at it slightly differently. We look at it slightly differently. We long-term investors. So people who are long-term investors here, I know quite a few of you, think like that. It can be very, very powerful using put options. how selling a put option can hurt us when done wrong, and how can you do it wrong when you think that, you know, when you try to speculate saying that, oh, you know what, NSP will not come down to 50, so, you know, I don't have to keep the $5,000 aside because I will not get assigned. This is just free money, and that is doing it wrong, and that is being speculative. Because most traders who are selling options, they have absolutely no intention of getting assigned. In fact, you will see I have watched videos on YouTube, very good quality videos. They cover all the concepts, but they treat option assignment or option exercise as if it's a taboo, you know, subject, whereas it's not. I mean, that's actually why options were, you know, human beings came up with options. You know, that is how it's meant to be used. It's a different matter that, you know, people, you know, trade them in the market. It's like, you know, trading insurance policies. It's a much more common thing to do, but, you know, we use it as investors. So we then looked at a case study of an end-to-end strategy of why and how we sell a put option. And this demonstration part, I will take it up after the Q&A session. So that is basically what we intended to do, and not bad. Today we finished it in 1.5 hours because I did not distract myself with questions. Okay, so now let's open the floor for Q&A. And guys, just a reminder, our regular monthly tutorial, which is supposed to be every last Thursday of the month, which happens to be today. So for this month, we shifted it to the 1st of October because we wanted to do this session. So that's, of course, a subscribers only. So only for our subscribers, we will have the registration link available on the Investing Fundamentals and the Option Series Facebook group. So remember to register. We are going to cover a lot of interesting strategies, you know, advanced strategies, and basically taking things to the next level from where we leave this session. Okay, so I'll take a water break and question answers. Fan Liang, floor is yours.
Yep. Cool. So we've got a couple of questions just now.
Okay.
I'll just go through them one by one, and some of the questions have been answered by helpfully by some of our members here, like
Awesome.
YWAP and Ruth. But
Awesome.
I'll just repeat them and see what you have to say.
Yeah.
So the first one is from Lance, where just out of curiosity, is buying a put option equivalent to shorting the market with a hedge risk?
Buying a put option is a proxy for shorting the market. You're absolutely right, with an advantage and a disadvantage. What is the advantage? When you're shorting the market, your downside risk is unlimited. I mean, you can go and ask people who thought they were very smart and shorted Tesla, and before that, you know, I know people who are many of you would know this guy, the writer of the book Columbia Business School, Professor Bruce Greenwald. You know, is a well-known professor, wrote a book on value investing, and in his infinite wisdom, he decided to short Amazon when Amazon share price was 670. And a few years back, I was in Columbia Business School doing an executive management program on value investing, and his colleague Tano Santos was telling us that Bruce was, as of that day, he was down $20 million. Can you imagine? And I'm not sure. And he was stubbornly sticking to it. So I don't know what happened after that. But if he stuck onto his position, I don't know, maybe he's gone broke or whatever, you know. So that is the downside of shorting, because it comes with unlimited risk. Whereas buying a put option, your risk is limited to whatever premium you pay for the option. However, the disadvantage is that you might overpay for that premium. So you have heard me saying earlier that, when you're doing options, don't think of just one position, one trade. Think of it as a system. So while you might think that, COVID is hitting, I'll just buy a put option and, I'll go to sleep in peace. But guy, you have to think lifetime. If you keep overpaying for put options throughout your life, maybe, your overall long-term investment returns could have been a healthy 15%, but you know what? It can be slashed to a low single digit percentage just because you have not been careful about buying puts. So in principle, similar to shorting the stock with these caveats. Lance, hope that answers your question.
Yep. And then after this, we have quite a few questions from Priscilla.
Yeah.
I'll read them out and I've also put in the chat. And in the meantime, if anyone else have any questions, feel free to start thinking about them and we'll be happy to answer them.
By the way, Priscilla, a special note for you. Sometimes I feel you're the only person who is seriously following the course. I absolutely wake up in the morning and I look forward to your question. You ask a lot of questions, and I wanted you to know that I really appreciate your questions. So feel free to keep asking, because as I've always said, the more you ask, the more you learn. Never ever think that hesitate asking just because you think that, oh, is it a silly question? Is it a stupid? No question is stupid question. So
yep,
keep asking.
That's a good point. Yeah. So the first one will be, I wish to know how to protect our investment with the use of put option near the election day. Specifically, the consideration that goes into thinking how to choose a strike price and the expiry. Thank you.
Priscilla, the easy answer for that is I don't know. I have no clue. Because if you have been following what I've been saying, look, this is not the first time America is having an election, right? Presidents come and go. Yeah, there is short-term volatility. So I personally, or my partner Fan Yang, we do not consider the short-term, gyrations in stock price something that we need to protect ourselves from. The best protection for you is your knowledge of your underlying business. So if, let's say, some person sitting somewhere, let's say in Miami, Florida, who is very worried about the elections and decides to sell, and looking at him is his friends decide to sell, they may not even have a clue of what they're selling. They may not even have ever gone past or even opened an annual report or a 10K or a 10Q, or they may not even know the name of the CEO of the business there. Maybe they went and purchased that stock because on some Facebook group they have got a tip based on that. So why on earth should I be bothered if they are selling and looking at them, there is a domino effect and people are selling? For me, I will be delighted if that happens, because two things will happen. Either the share price will go down so much that I will be able to, all the great businesses which Fan Liang and we have been waiting patiently for, maybe we will be able to buy them at a great price. Or even if we are unable to buy them, maybe the share price will not crash till that extent, but the price of the puts will go up significantly, because many people, just like you have this question in mind, many people will mistakenly think that, oh, we should just go and buy put options. So that will push up the price of the puts, and I will be a happy seller of put options, positioning myself to be able to, I'll be happily taking the obligation of buying my favorite stocks. And the return calculation which I showed you, instead of 16% or 18%, there is a chance that that return that I will make during the election time can be 35, 40%, So it's times like these which play a huge role in pushing up my long-term return on my capital. So, there is nothing to protect really. I mean, I really don't know how to protect. So that's my answer.
Thank you. The next one is, why do you sometimes sell puts that have 60 days maturity, and why do you sometimes sell a lead put, which is more than 1 year? What are the considerations to your decision and on the strike price as well?
Oh, Priscilla, this is something which I've covered extensively in the option series. So I look at the return, which we we calculate the XIRR. So right now, I don't want to get into details of that because that will not be relevant for the beginners. And today I have promised myself and many of the beginners who have given me feedback that I will stick to whatever we discussed in today's session. So this is a great question. I'm not discouraging you. You put it in the group, the course group. I'll respond it there, or bring it up on 1st of October, or you can watch the video. So there is a very good reason why I decide what I decide, whether 60 days or whether sometimes it's 90 days, whichever gives me the highest return. So
yep.
Next one.
Cool. The next one is, if after selling a put, I change my mind and I no longer want to be exercised as the price is coming down, do I keep rolling it down until it eventually doesn't get exercised? And if so, will there come a point where I can't get away from my obligations?
Yeah, you can. I mean, again, there is no right or wrong answer. In fact, I change my mind quite a lot. I mean, there's nothing wrong in changing your mind. Like even this example, what I showed you, you remember I showed that our calculation of the range of intrinsic value for NSP is 60 to 80. So then I should be heavily going and buying. But I changed my mind about my margin of safety requirement because of this COVID. And instead of buying it at 60, I'm buying it at 50. Now, let's say if there's a major second wave, okay, and many of Inspirity's clients get affected, I might change my mind again and I might try to roll it down from 50 to 45 or 40, whatever. Having said that, yeah, there will be a time when maybe, I think that that's enough changing of mind. Now it's offered me enough margin of safety, so I'll go and buy it. So it's a subjective decision. You have to, I can't give you a thumb rule. You understand? There is no rule to this. I mean, you have to evaluate it, on a case by case basis. But it's okay to change your mind, and and there are other things that that you can do. But the very fact that you sold the put, I'm assuming that you were okay with buying the stock, and that conviction should only come once you have researched the business well, at least in our scheme of things. If you sold the put with the objective of trading, I'm sorry, I can't add much value to your life, because as I have mentioned to you several times that I'm not a trader, so I don't think like a trader. Okay. Next.
Yeah. Similarly on this topic, when is the best time to roll it down? When the price is near the strike price, or when the expiration is within days or weeks away?
Okay.
For example,
sorry, Fanliang, to interrupt.
Yeah.
See, rolling a put, again, it's an advanced topic, so it's outside the scope of this, because I don't want the newbies to be confused by these terms. We haven't talked about rolling a put, so let's keep that for the 1st October tutorial. I promise I will address all these questions, Priscilla. So Fanliang, let us just pick up those questions which are relevant to this session. That is how this session will be more meaningful.
Sure, sounds good. The next one is a bit more general, just on how many stocks do you hold in your portfolio, and do you only do options on these stocks?
Yeah, okay. My portfolio is quite concentrated. See, let me qualify that. if you look for absolute number, there are quite a few stocks, but the meaningful holdings, I think just 6 stocks add up to over 80% of my total portfolio. So it's quite concentrated in that sense. I mean, I have small positions, just a foot in the door kind of a position, which where I'm waiting, some of them for eternity to, to be able to buy. Like I told you, right? Some of these companies which Fanliang and I we will, release soon in our research series. I've maybe taken a small curiosity kind of a position. But yeah, to answer your second question, the option positions where I using this strategy of selling a put to be able to buy, yeah, these are always on companies which I have researched, which I know on these, barring very few exceptions. There is one exception I can think of is a company called Jumia, where I sold a put, but I do not have an intention of, I mean, if I have to, I will. I have the obligation, but right now I'm in no mood to own the stock. I want to watch the company for another couple of years, but I sold the put for reasons which I explained in the video, which is available in option series. There's actually a very good reason why I sold the put. And that reason is valid even if Jumia goes bankrupt and goes to zero. So you can watch that video, but fairly concentrated position. But again, there is no right or wrong answer. I know people, in this group right now on this Zoom call who are very good investors. They have many more stocks. I know people who just hold 3 or 4 stocks. So, it's completely your choice. Yeah, next.
And I think we have only one last one. So in the meantime, if anyone else have any questions, feel free to put them in. So the last one on the list now is going back to that example where you have sold the put on Expiry with a 50 strike for 205 days. What if the stock dips below $50 during the 205 days? Would you close your position, which means you have to take a loss on that put and buy the stock directly from the market? And I think the context is probably just so you get the opportunity to buy it at a low price in case the stock price rebounds back if, say, COVID goes away.
Yeah, I could do both, Priscilla. I would not close the put. The put, I have taken that obligation because closing the put means I'm completely giving back the return which I made on that $5,000, right? So I will let it run. And that is exactly a position which I have right now. I have a position on Expiry, a short put, which I think the strike is $80. So, but Expiry had fallen to, so your question is exactly the situation which I currently have been. So the strike of that was $80 and I had written that put, at the time when we evaluated the range between 60 to 80, right? And that time the premium was not so high. So I sold at $80, but then subsequently Expiry price went all the way down even below 30. So I have been buying Expiry from the market, and this particular put, I rolled. But I promise that today I will not talk about roll. But yeah, there are ways in which you can adjust positions. Let's keep that for a later day. But I will absolutely go and buy more from the market as well. Yeah, absolutely.
Yep. Thank you for those. Priscilla, if there's any follow-up, feel free to put them in. And as of now, I think we don't have any further questions from the floor.
Okay, so if there are no further questions from the floor, let's go back to interactive brokers and let's actually go and now the markets are open. So I'll share the screen again. Fanliang, screen visible?
Yep, we can see it.
All right, so here we have NSP. Don't pay too much attention to I know there's a lot of writing, just pay attention to this section. So I pulled out the April 16, 2021 expiry. On this side, you have the calls. On this side, you have the puts. Okay. Now, again, don't pay attention to these delta, gamma, vega, theta. It's, right now it's not relevant. So we decided to sell the 50 strike put, right? So you see the 50 strike put currently, the bid is $4.40, which is what we had used in a calculation, and the ask is $5.90. Now, so to place an order, what you do is you just go here. And by the way, before I place the order, let me just double click on this. And by double clicking, it opens up the option contract. So you see, security type, this is an option.
Rupam, I think you need to switch the screen.
Oh, okay. Oh, this is funny. So if a new pop-up opens, it doesn't share. Okay, so when I double click, this pop-up opened up. Okay, so you see, this is how I get to know all the specs of the option. So security option, the underlying is NSP stock, the contract month, April 2021, expiration date, 16th April, strike 50. Okay, now if I double click, by default, it opens up a call. I don't know how to open up the put. That's funny, but anyway, you can make out from this itself, industry, sector, blah, 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 product. Okay, settlement method, physical delivery. You remember in the first part, I had talked about physical delivery or cash delivery. That is, if I sell the 50 strike put and if the share price comes down below 50 and the holder of the put, that is the buyer of the put, if that person decides to exercise, so I will be assigned the put. So I will take position, I'll be forced to take position or forced to buy the physical shares. I mean, not paper shares, but forced to buy the shares. So that is called physical delivery. And exercise style is American. You remember I mentioned that American means it can be exercised by the owner of these put options on or before the expiry date. If it said European, then that would mean that it can only be exercised on the expiry date. Okay, so that is what European would mean. Okay, so coming back to NSP, so I come to this 50 strike and I just click here. So see, when my cursor is here at 440 and the tip has come up, sell leg. So I click on this and this opens up, and I guess I have to share again, right?
No. We can see it.
Oh, you can see it?
Yeah.
Okay. All right. So here it says the action, under action, it says sell. Right now, I'm not worried about any of these at all. So sell, quantity. I'm just selling. Here one means one contract, which is controlling 100 shares. The order type, okay, very important thing. Always, 100% of the time when you're putting in an order, put a limit order. Never ever put a market order. You know what will happen if you put a market order? Let's say, by the way, this is not real-time data. Okay, let's say I'm doing a big position. I am buying 100 quantities of these. Now, I'm seeing that the bid ask is $4.40 and $5.20, but I don't know how many people are bidding $4.40. It might so happen that the bid of just one contract is $4.40, and after that, the bids are much lower. So if I put a market order, then the order might get executed at a much inferior price. So always put a limit order and ask for the price that you want. It's all negotiable, you know. Just because it shows $4.40 doesn't mean, even though I did my calculation using $4.40, doesn't mean I have to accept $4.40. The ask is 520. So typically what I do is I put in my order. You can put it in the midpoint. So here the midpoint would be 480. I would typically, let's say I also want to get it filled. So, oh, see, it has now gone up to 450. So let's put the order at 470, you know. So I'm basically slashing 20 cents. I'm getting 20. I'm being greedy. I'm getting 20 cents more. Not getting, I mean, I'm asking for 20 cents more. I say that I will only sell if I get $4.70. Now here, what's happening is the guy who is the current best price is $5.10, right? Whereas the guy who is the best bidder, he wants to buy and this person wants to sell. So I'm saying that, hey, Mr. $4.50, I will sell to you, but I will only sell to you at $4.70. So please come up. That is what I'm saying. So this destination, if you're using IB, I always keep it at smart, which means IB does the smart routing. IB decides which exchange to send it. I really don't bother about, these things. The smart is good enough because I'm putting a limit price. If you're a day trader, you might find value in knowing the advantages and disadvantages of sending a particular contract to any of the exchanges. I don't know, neither do I care. It doesn't matter. I mean, it doesn't make my life any, because, my quantity, if I just put smart, I mean, as long as I get a fill at my limit price, it's good enough. Time in force, it's a good practice to make it GTC, which stands for good till cancelled. If I leave it a day, then what will happen is, if today this order does not get executed, this order will vanish. So tomorrow I have to again come in and it will only be valid for the day. Whereas if I just keep it GTC, it means it will be good till cancel. Often it happens that I put in an order, it did not get filled on day one, it got filled after 2-3 days. Fanyang, by the way, you put in some order in our MoneyWise Smart account yesterday, right? Some are still open, right?
Yep, a few days ago.
Yeah, exactly. So, we will go and check from time to time if they have got filled. So that, then you have these buttons, allow this order to be filled outside regular. These are more relevant for, stocks, not options. So after that, I can directly transmit, but what I do is I first go and accept the order. I get a message, you have a new order. Would you like to expand the order panel to view the new order? So yes. So here I see the order which got populated. So the reason I did this is it's a good practice to go and check the order. Just few days back, one of our friends, he posted that instead of buying a particular expiry, he ended up buying an expiry which was just 2 days away, and that was a mistake. So sometimes these mistakes happen. I have done these mistakes, I'm pretty sure, more than, most of you. So that's why now my system is I always go and check. So, okay, NSP, April 16, 21, this is the expiry I wanted, 50 strike, put. I have even stupidly, instead of put, I have gone and sent an order for a call. So I check everything. The bid is 430, ask 510. Okay. Yeah. So here, this may not be relevant for everybody. So on IB simulated trading, there are just so many sub accounts it's showing. So I just select the sub account. Otherwise, the action is sell. That is what I want. One quantity, good till cancel, limit 470. So now I will just send the order. So see, it throws up this one. I can do all kinds of analysis and all these things. Fanyang, can you see the pop-up? Hello,
Yep, we can see.
You can see this pop-up, right? Okay. So this is the order pop-up. I won't bother about this window. This is the order pop-up. So I had put in the order at 470 limit, multiplied by 100, right? So the total amount I will be bringing in is $4.70. IB is giving me an estimate of the commission. It is not giving me the exact commission because finally it will depend upon which exchange it will get, sent to and filled, etc. So roughly an estimate. It's not too much. This. So in this particular paper account, they have put in $1 million. So if you start with it, you can also start with $1 million. I think earlier it was possible to even change that. So, I used to have a lot of fun, changing it to $1 billion, and all those things. But right now, I think they have got fed up of people playing around like me. So I think they have just made fixed. So this is the total, and this is the first order I'm placing in this particular account. So this is the total account value, $1 million. Now, after placing that order, remember I showed you that the interactive brokers algorithm is evaluating the total risk of the order as $5,000. But the total amount of margin it requires me to put up is not the full $5,000. It is only $748, which is the initial margin. But what one really needs to worry about is the maintenance margin, this is the margin one needs to maintain. So I can place this order even by just having $700 in this account. And that, my friends, I'm saying is a mistake. Priscilla, to refer to your question that if, let's say, I place this order and I go off to sleep, and what if NSP crashes like it happened some time back? What if it goes down to 30, maybe 20, 25? Then what will happen is, while I'm sleeping, the interactive brokers software will calculate that the risk in this position has gone up, and it would want me to put up more margin. Typically, that's what other brokers do. That is where that term margin call comes. They send an email and say, hey, you have to put up more margin. But in case of interactive brokers, they don't do any such nonsense. They will just go and liquidate this order if this is the only order you have. If you have other stock positions and stuff like that, their algorithm will randomly pick up a stock and so your most favorite stock might get liquidated at a very wrong time if you don't keep an eye on this margin. So the safest thing for me to do is to ensure that at least I have $5,000 in this account, because my worst case scenario is a $5,000 loss, right? So I will ensure that. Right now, of course, it has much more. So that, and I will then go and, yeah, so current position is 0. If this order gets filled, it'll have -1. -1 is one contract sold. So I will overwrite and transmit. So order sell is just a pop-up. Don't display again. Okay. So at 470, maybe it will get filled after some time, but if right now what I'm doing, I will not do, but assume that a day has passed and it did not get filled. So let me go closer to the bid. Let's say, what if I put it at 465? Will it get filled? Maybe after a day, I will go and change it to 460. No. So here there is no room for any ego, at the end of the day, whatever gives me the fill. So right now I'm doing it every few seconds, but in reality, I'll probably do it, every few days. I mean, there is no rush. Okay, so now you see what happened. This is my order, and the best bid also is 450, which means if I leave it here, the order will get filled. The only problem is these are not the real-time prices. So I'm not sure what the real-time price is. So if any of you are logged into, let's say, a Thinkorswim, and if you have access to real-time option data, will you be so kind to let me know what is the current real-time bid ask for this particular option? So while you are doing that, let me just go and just get this fill, So clearly this is not real time. Maybe the price has moved. This is really irritating, right now it might appear to you that how come I'm going even below what the bid is. I just want to get it filled. This bid and ask, this might be a delayed bid and ask. So I don't know what the real time bid and ask is. Okay, the order just got filled at 4:30. There is even a voice. I don't know if you guys heard the voice which said order. So can you see this?
Yep. And a few of them were kind enough to help us check on TOS, Think of Swim, which says that it's 4:30.
Okay, so all right. Okay, excellent. So 4:30 is where the order got filled. So now I have this. If I go to my trade log, you can't see the trade log, right?
Yep, we need to switch.
Back to meeting. Now?
Yep, we can see now.
Okay, so see, I got this confirmation that this order got filled. It was sent to this PHLX exchange, whatever that stands for. I used to know these, but now I have forgotten. Viva will probably know. Maybe, is it Philly or whatever? Doesn't
Philadelphia.
matter. Yeah, Philadelphia. Okay. One contract, price 4:30, it got filled at this time. Submitted Rupam, and the commission I paid is $1.10. So the summary is that 4:30 minus $1.10. So this is the commission that I have brought in, 428.90. So imagine $5,000 is what I have blocked because of this, and I immediately got this return, which is a pretty healthy return, and I get this money upfront, which means that because I got this money upfront, where is my position? This is my portfolio window. So you see, in this portfolio window earlier, I had $1 million cash. Oh, again, I have to share. Sorry. This is one thing which is, I find very painful about Zoom.
Yep,
now you can see, right? Okay, you see in the portfolio window, it had $1 million. Unfortunately, not real money, paper money. And now $429 got added to that. Okay, so this is the cash which I have. And I have this position showing as -1. This is my weighted average price after taking into consideration the commission. And this is the current bid ask price. So now look at this, guys, daily PNL minus $35. Why is it showing a loss of 35? Because imagine if I have to close this position right away, then, so what I did was I sold an option to open, that is STO, sold to open. So I can get rid of this obligation by buying back this particular contract, right? I mean, I don't want to buy back because I'm happy to buy NSP at 50, but if I buy back this, then my obligation goes away. But I have to go and buy back at whatever is the ask price currently. And probably the ask price is maybe $4, whatever, 65 cents. And that's why it's showing a $35 loss. So that is how an option is sold. Now, one extra step that we do, which is, let me just quickly go back to the presentation and show you. You can see the presentation, right?
Yep.
So here you remember I had mentioned that, you know, if I just don't do anything with the $430 that I brought in, that is kind of equivalent to investing $5,000 and receiving $430 at the end of the period. But because I have received the $430 upfront at the beginning of the period, what if I go and actually invest this $430, and I can, over the period of the life of the option, it is possible that this $430 investment also can grow, right? So that is what can enhance my annualized return. So that is what we typically always do. So in this particular case, what I would do is I have $430 to invest. So that is like, think of it like this. You have received a dividend from your company. If you don't invest the dividend, if you just go and, you know, treat yourself to sushi, that's it. Your return is whatever the dividend return is, but you're effectively enjoying a simple interest. But if you reinvest the dividend, that is how compounding happens. And, you know, as I'm a worshipper of compounding, I will go and invest this $429. Where can I invest it? What if I just go and buy the NSP shares? And how many shares can I buy? Can someone quickly calculate and tell me? With $430, how many shares can I buy? 7, I can't buy 7, right? So 6 shares. Because as per my calculation, this is still, I remember I have to share the screen once again. You can see this pop-up, Fanlia?
Yep.
Yeah, so as per our original calculation, you know, the intrinsic value range was 60 to 80. So 63 right now the share is at, it's still a decent price. So I will just go and place an order. I can just buy what, 6 shares, right? 6 for whatever, 63.01, doesn't matter. You see, and I just go and, so this I'm buying 6 shares. 6 shares. Okay, $378. You know what, here, just to make it get executed as a small order, I'll just use market, but never ever use market. For shares, you know, it's okay, just to get it filled. So $63.28, it got filled at. So that is how I reinvested the premium which I brought in. So that's about it. That's how you place an order. Now, if I wanted to buy an option, I would have gone and clicked on this ask. Okay, so that brings me to the end of my prepared presentation, and again, I'm ready to take any questions that you might have.
Yep. So we have got a few questions from different people, I think about 5 now. Yeah. So I'll start with them, and if anyone else have any questions, feel free to continue to ask them. So the first one is from Priscilla asking, is it common for buyers of put options to exercise before expiry date?
Priscilla, it completely depends, right? When it makes sense to exercise. And that we have covered extensively. So you can watch these videos because if by selling, as I explained earlier during the presentation, if by selling the option in the market, you get higher than what you get by exercising, then you would not exercise. Then you would want to sell, right? Because remember, when you exercise, you are only benefiting from the intrinsic value. You are completely foregoing the time value or the extrinsic value. So if an option still has some time value left, why would you want to exercise it? If you want to close it, you would want to close it by selling it. You would only consider exercising it if the option does not have any time value left, right? As I explained in the presentation. Next question.
Sorry, I think.
Yeah, Priscilla please,
has
yeah, just unmute her, and in the meantime, we can look at some other question.
Yep.
Actually, I would, you know, if anyone wants to ask, I would actually prefer them asking in their own. I don't know if is.
Hi, Rupan.
Hi.
Hi, Priscilla here. I'm just thinking about like if I sell a lead put option which expires in a year's time, then suddenly the market turns bearish or the fundamental is no longer there, and the stock market crash. So being a seller of the put, do I have to worry that the buyer would choose to exercise early before even the 1 year's time is up? Is it a common thing that people do?
Good. I mean, good. If, okay, first of all, for the benefit of all the newbies, Priscilla used the term leap option. A leap option is, in simple terms, it's a far dated option. It's an option which has an expiry date of 1 year or more. Sometimes we even have options expiring in 2 years time, 2.5 years time. So, so Priscilla, what happens is that, first of all, if the option still has, you know, more than a year to go, it's highly likely that the option will still have some time value. Okay. Having said that, if the option is deep in the money, like I showed, when an option is very deep in the money, the time value reduces. Okay. Again, that is why it happens. What exactly happens, that is outside the scope of this. So if something like this happens, and if, let's say, I'm the owner of the put option, yeah, I could exercise. I mean, I can't tell you, you know, how common it is. So it depends upon lots of ifs and buts. So if a situation is ripe for exercising, a rational buyer would exercise. You know, I would like to consider myself as a rational buyer, so I would exercise.
Okay, understand. I'm just thinking of in terms of a black swan or suddenly there's a fraud case.
Yeah.
So people
possible, absolutely possible. So,
yeah.
so that's the reason. See, the very first, you know, thing that I would mention, I mean, you know, in the scheme of things, like the way we think in, you know, option series, if you're going by that principle, look, you would not worry too much. What can be a possible black swan which can completely, let's say, wipe out a business like Facebook or you know, and Amazon or one of those, you know. So yeah, the share price can drop, but then I know it's very difficult for someone who, you know, who thinks like a trader, but you know, I guess that is the biggest difference, that when you're thinking like a business owner, you develop the ability to sleep through some of these black swan events. I mean, what else? Because you can't control them anyway, right?
Yeah, just like thinking of about a Luckin Coffee or a World Card, something just turn. So
that kind. Oh yeah, possible. Or Wirecard. Yeah, possible. Yeah, valid point. And that's where position sizing comes in.
okay.
That's where position. By the way, I mean, you know, I have had such black swans. I mean, not in my listed businesses, but in private investments. So yeah, possible.
Okay, thank you very much.
Yeah.
Probably it's worth jumping to another question by Wei Wo on this topic.
Yes.
So if the assignment happens, how does the broker determine whose options should be assigned? Say if there are 10 people.
Oh, that's completely, that's
exercise.
completely random. That's completely random. I have actually checked this with interactive brokers. They can't give any rule. So there is absolutely zero control you have. It is very possible that you know, you and your wife both have the same short option. That is, you sold the same option, and you get assigned, your wife doesn't get assigned. It's very possible. So that is what interactive brokers told me. It's completely random. Their you know, software picks it up. Don't know on what basis.
Yep. And I just remember something to add on to the question just now in terms of the response. I think sometimes the holder of the options can make mistakes too when they're pressing on the platform. So they could be doing things that are not rational too. Like some of our members in our course have made mistakes when they try to execute an order too. So just to add on to that.
Yeah, absolutely. Oh, Fanlian, I have made lots of mistakes in placing my orders. I mean, in the past, that's the reason now. Of course, now I place much fewer orders, but it's very possible, especially when you're trading. You know, when the markets are moving, lots of red here, there, lots of emotions. It's very difficult to stay rational. It's very difficult to stay rational.
Yep.